Hello and welcome to Options in Plain English. Today we're going to talk about volatility skew. In theory, an underlying should have only one volatility, representing the standard deviation of returns over a certain period of time. When dealing with implied volatility, however, every option, call or put, has a price, and this price implies a level of volatility for that option in particular. When we talk about volatility skew, we are referring to the implied volatilities for all the options of an underlying on the same expiration and arranged by strike price. In this lesson, we'll see how this affects the design, execution, and management of our options positions, considering the existence and nature of its volatility skew. We're going to start by looking at an options chain, and we have the information here for Apple, AAPL. Apple was trading at this point at $317.33. So the at the money is going to be $317.50, which is the strike price that we have right here. We have the puts, we have the calls, we have the out of the money calls, the in the money calls, the out of the money puts, the in the money puts. I've already pulled up the information for implied volatility. So we have the different implied volatilities. One of the things that we notice here is that the implied volatilities for different strike prices and for different types of options, so puts and calls, are different. So for example, the at the money put, which is this one, is trading at an implied volatility of 27.39%. But if we go lower in strike price, we see that the implied volatilities are different. And if we go higher in strike price, we notice that they're different as well. Same with the calls. At the money, the call is trading at 28.01%. And once you start going higher in price or lower in price, they're all different. Now, every option price is determined by several factors. For example, stock price, strike price, time to expiration, implied volatility, dividends, interest rates, and cost of carry in general. Now, we can notice here that if you have an option price, you can determine that option's implied volatility. This is why we have all these different implied volatilities. Now notice here that we're only analyzing a single expiration. This is why what we're looking at is called volatility skew, or some traders call it vertical skew, which means for a single expiration based on strike price, what is the pattern of the implied volatilities for all the different options. If we were to consider the volatilities for different expirations, that is called horizontal skew, or it's also called term structure. So it's the term structure of volatility. If we put the volatility skew and the term structure together, then we have what is called a volatility surface, which is all the different volatilities for all the different options that exist for a certain underlying. In this case, in this lesson, we're only going to be talking about volatility skew, which is a single expiration, all the different implied volatilities. We're going to arrange them by strike price, and then we're going to see if they form a pattern and if we can get any information or if we can get any insight from how the implied volatilities are arranged based on strike price. Now we're going to take all those implied volatilities and we're going to arrange them in a single graph where we have the strike prices on the bottom, so on the x-axis, and on the y-axis we have the implied volatilities. In this case, since we have calls and puts, what's going to happen is we're going to plot only the out of the money. So there's always going to be one option for every strike price, and it's going to be the out of the money. Okay, we have the so that we know where we are, we have the at the money right here, which is the 317.5. This is where the price is right now, and you can see that the implied volatilities are different, and not only are they different, they form a very standard pattern. Okay, so this for example is the implied volatility at 295 is this value. The implied volatility at 290 for the strike price, that's 290, is this value. So we can see that this is a curve that has a certain value at the at-the-money, and then the strike price is higher, are going to be a little bit lower until it comes to a point where it starts going back up. But the overall pattern is that from the at-the-money, the lower strike prices have a higher implied volatility, and the ones that are higher have a lower implied volatility. And we have several different patterns that have already been identified by traders. So for example, this one, where we have is this very symmetrical shape, is called a smile. This one, which is what we have, is called a reverse skew. And this is what usually is present for equities, equity indices, equity ETFs, individual companies, etc. This is another pattern which has the lower strike prices having a lower implied volatility than the higher strike prices, which have a higher implied volatility. This is called forward skew. And this is present in products such as commodities or anything that has a perceived floor to its value. So for example, commodities, for example, oil, gold, also some products such as the VIX has forward skew because it tends to accelerate on the upside and not on the downside. This is a pattern that is not present a lot. I haven't seen it a lot, but it's called the Frown, which is at the money you have very high implied volatilities, and then on the out of the money strikes you have a lower implied volatilities. In this case, for equities, for equity products, we usually have reverse skew, which means that the low strike prices have high implied volatility. Why is this? Well, there's many theories as to why this is. One of them is because when there is a shock to the system and there's a crash or an event such as that, the overall prices tend to go down with a high velocity. Because of this, there's always the demand for protection, and puts, out of the money puts in this case, offered that protection. That's why this protection, the puts are elevated in price, and that's why they show an implied volatility that's higher than the at the money or than the higher strike prices. In the case of calls, which would be here, the theory is that many investors, what they have is when they have a already an underlying position, maybe they're long stock, what they do is they start selling calls, creating a cover call, which is one of the option strategies that we already saw. A cover call, you sell a call. Because of that, there's a lot of supply and not a lot of demand. That's why the prices are pushed down. Another explanation, and this makes a lot of sense, is that if we have a certain level of implied volatility at a certain strike price, for example, let's say we look at the 290. If we ever get to the 290, so if the price of Apple ever goes to 290, it means that it went down. If it went down, it means that the implied volatility likely went higher, because usually when prices go higher, the implied volatility goes lower. And when prices go lower, the implied volatility explodes to the upside. So in a way, this is a sort of a forecast or a prediction as to where the implied volatility is going to be when it reaches this point. So it also makes a lot of sense. So it doesn't matter what you think of it, how it got there, the explanations. What's important is that you understand what it is and that you see what it is and try to take advantage of it and try to capitalize on it. Now, as we mentioned, we have volatility skew. It's the same expiration, but we also have term structure, which is the how volatility changes over different expirations. All of this together is called the Volatility Surface, and it's a collection of all the different implied volatilities for all the options. And traders that are heavily involved in trading implied volatility analyze this volatility surface, its shape, and how it changes, it shifts, and how it changes shape over time. So this is something, just so you know, that it exists. At this point, we're only talking about volatility skew. Later on, we're going to talk about term structure in a different lesson. Now, based on all the things that we saw today, why is volatility skew important to us? Well, it makes options at certain strike prices relatively cheaper or more expensive. So the ones that have a higher implied volatility, relatively speaking, are going to be more expensive than the ones that have a lower implied volatility. Now remember, there's also strike price, stock price, time to expiration, which is going to be the same because we're analyzing the same expiration. But there's also where the stock price is relative to which strike price we're talking about. So that's going to be the main factor. But all things considered, certain options are going to be cheaper and certain options are going to be more expensive. And this is based on implied volatility, and this is analyzed for the same expiration by using volatility skew. Some option strategies are better suited to take advantage of certain IV skew environments. So there are certain strategies, and we're going to be talking about them later, that are constructed, that are designed in particular to take advantage of this. One that comes to mind, for example, is using a short put and not using short put spreads, because when you sell a put spread, you have to buy via a long put that's at a lower strike price, and that one's going to be expensive, making the whole credit that you receive not very appealing. So there are certain strategies that try to take advantage of this. Once positions are initiated, the IV skew and also the term structure is one of the factors that influences option pricing and can directly lead to profits or losses when the IV skew is getting steeper, flatter, or changing shape altogether. So IV skew also is a factor in the profits or losses of our positions. Why? Because IV skew is going to change the implied volatility, and implied volatility is one of the factors in option pricing. Higher implied volatility is going to lead to higher prices, and lower implied volatility is going to lead to lower prices. It could be seen, volatility skew could be seen as a predictor of where IV will be if and when the stock price reaches that strike price, which is what we're talking about. It's a sort of a forecast. In this case, if the price ever gets there, then we're going to be in an environment with an elevated level of implied volatility, and this is what skew is predicting in a way. Because of this, most options positions are initiated by using delta as a criteria for strike selection. Delta already takes into account the IV skew information, since delta depends on the IV of that particular option, along with other factors. So this is the most important thing for us at this point. When we're going to start putting together, or we're going to start putting on different types of strategies, where we're going to start combining, we've already started combining long options, short options, calls and puts, and also stock and short stock. And at this point, we have considered the strike price as being somewhat independent of the environment where this strike price is being analyzed. It really isn't the case, because what we should be considering is delta. So, for example, if you want to sell something on both sides, which is what we're going to start doing, you can't just go $10 down and $10 higher and consider that this is going to be a position that's symmetrical, because maybe you have a different implied volatility skew. In that case, your position is not going to be symmetrical. It's going to be symmetrical in price, but it's not going to be symmetrical in delta, and it's going to have a directional component which you don't want. So the bottom line here is we need to start thinking about delta when we select the strike price that we want to sell or buy, and that's the way most traders do it. If I tell you that you should go to a certain stock and sell the 35 delta, I don't need to tell you what the price is going to be. I'm just telling you the delta, and that takes everything, all of this information into account, and that is the way that option traders put positions on. They always use deltas, and we're going to start talking about neutral strategies. We're going to start talking about strangles, straddles, iron condors, and iron flies, and those require positions on both sides, and we're going to have to start talking about delta and not so much about price. That's the reason why we need to understand what IV skew is and why we focus so much on delta when we do our strike selection. I hope this information has been relevant and has been useful for you guys, that you can start taking this information and with the information that we're going to get later on about the different positions, we're going to start building positions that more accurately reflect our outlook for a certain underlying. And with that, you're going to be able to put on better positions for you. Thank you very much for your attention, and goodbye.